Dear investors, numbers always say something, but not every number tells the truth. Sometimes it is within the gaps left behind by numbers rushing past us that the deeper truth is revealed. The company we're going to talk about today, Nice Lilted, is not a traditional tech company. It has built a unified platform strategy across three completely different industrial structures, and that very fact sets it apart from conventional tech firms. However, this multi-layered structure sometimes hides important signals. Let us begin tracking those signals now. On August 14th, 2025, NICE released its quarterly earnings just before market open. Total revenue stood at approximately $720 million, up about 9% year over year. Cloud-based revenue also grew by around 12%. These figures are widely considered reasonable growth rates, but one single line, one single figure brought all other analysis to a halt. Annual recurring revenue, ARR, related to artificial intelligence and self-service, jumped by a staggering 42% compared to the same period the previous year. Ordinarily, for recurring revenue to surge like this, there should be a clear trigger. It could be a large new customer, a major upsell from existing clients, or a significant price increase. But none of these explanations appeared in the released materials. For investors, this absence of explanation becomes an extremely important signal. An unaccounted acceleration in revenue compels us to question the structure itself before considering strategy or technology. And this is where the first mystery arises. What exactly enabled NICE to deliver such explosive growth in recurring revenue? And why didn't they offer a clear explanation? The mystery deepens with the next development. On September 8th, 2025, NICE officially announced during trading hours that it had completed the acquisition of Cognigy, a Germany-based conversational AI technology company. NICE declared plans to integrate Cognigy's technology into its network of over 25,000 distribution channels, clearly signaling a strategy of expanding both technology capabilities and commercial reach. But here lies the issue of timing. Typically, the impact of an acquisition is reflected in earnings from the quarter following integration, once customer implementation begins. However, in this case, the earnings already included a 42% ARR surge before the acquisition was announced. This is where the second mystery emerges. Was the ARR growth entirely unrelated to Cognigy, or had internal integration been quietly progressing already? The first hypothesis is that NICE had already strengthened its recurring revenue structure through internal capabilities, without any contribution from Cognigy. If this is true, the results are indeed extraordinary and could indicate robust